This is a download from BFM 89.9, the business station.
Hi, good morning, Dodge. Let's have a catch-up on what the corporate earnings are so far in the United States. What surprised you, either on the upside or on the downside?
Good morning, Julian. On the upside, Microsoft, Amazon both saw impressive gains in cloud computing. Amazon's quarterly revenue was 12%. That was a surprise. Microsoft's results show now that the CEO, Nadella, their turnaround is well underway. Mobile hardware and cloud services revenue are up sharply. That was good. IBM, unfortunately, had its 12th straight quarter on the downside, but the price of the stock hasn't reacted as much to that as to the future. Facebook results were very good across the board. Advertising revenue were up 46% year to year. User metrics were up double digits. We are very pleasantly surprised by that. Google's revenue and paid clicks rose slightly less than expected, although costs were lower, and that was important because they've been criticized for swelling expenses over recent quarters. So that was a little bit of a surprise. In general, industrial names showed stress from the strength of the dollar. Caterpillar, General Motors, United Technologies, Lockheed. Some of the consumer names also were not helped by that. Pepsi and Procter & Gamble, McDonald's, Yum Brands. There's a lot coming out, and it's fairly evenly matched on both the upside surprises and downside surprises, but the market is reacting more to the upside surprises and less of the impact on the downside.
So it's very much a mixed bag, and some also blame the stronger dollar for weakness in some of the corporate earnings as well.
Absolutely. That is what we were hearing, particularly in the consumer names. There is a real criticism about it, and unfortunately, they're going to have to ride through this for a while, and it's going to be hard. I mean, Yum Brands, they saw lower profits. There's a continuing drag in China. We're concerned about it. We're going to have to see if those companies can control the weakness caused by the U.S. dollar strength. It's going to be a big challenge for the next 2 quarters.
And the S&P and NASDAQ also had record closing. What does it say about investor conviction about the market, whether it can continue with this kind of trajectory?
Well, yes, most of the averages were up. The Russell 2000 wasn't, and that is a negative divergence from a technical point of view. What we're seeing so far, we're continuing to see a B-quality advance in an aging bull market. Stock selection is really going to be key to continued success. We remain bullish in technology because plenty of them, as we were talking about before, are doing very well. But look at JD.com, Click Technologies, Giganon, Adtran, Applied Materials, Avnet. There's a bunch of smaller cap and intermediate cap tech stocks that have not been doing well. So it is very selective. Overall, long term, we're still moderately bullish. We're watching very specific levels on all 4 of the averages, and both on the upside and downside, and we're really being driven by a technical analysis of whether investors are staying in the market. One thing we are seeing, Julian, is that they're becoming much more selective, and they're beginning to get interest in selling winners.
Now, there is a report from Bank of America Merrill Lynch that while the market has hit new highs for S&P 500, the cumulative U.S. equity fund flows have fallen very sharply, and this suggests that the market is rising on falling volumes. Does this worry you?
Well, it does. It is a concern, and it is true. It is the market, from a longer-term perspective, still remains too strong to try to short or to get out too soon. It's not a question of getting out quickly or in advance of anticipating a downturn. That doesn't make sense because the market continues to be strong. There are plenty of winners, although the number of winners is becoming more select. But if you think about an old bull market, as prices are bid up higher and higher, it follows that more and more stocks are gradually viewed by investors as overvalued and thus no longer in demand. And at the same time, overvalued stocks in continuing aging bull market, they're often prime candidates for selling, thereby expanding the supply of stocks. And so we haven't seen that balance move over to expanding selling at this point, but it's beginning to happen. But it's far too soon to pull the trigger and start being quite negative in the market.
Do Do you think that the events in Europe, for example, Greece, will play into what Janet Yellen thinks about where interest rates should go?
Yes, I do, which is kind of interesting because I think it would be better from an economic point of view, Julian, not a market point of view, but economic, if we could have the beginning of rising interest rates. That would get us back more into transitioning into economic valuations, fundamental valuations. It's not happening. Yes, Greece, it does seem it's dragging out, and there's still the belief that at 12:30 p.m., on whatever the night is going to be, that they will come through and there will be some kind of agreement. But boy, I'll tell you, it is pure drama at this point, and that is a concern. And I think Yellen is reacting to that and is not willing to do much to start the increase in interest rates until that drama has played out. So she's playing it safe, and from a fundamental economic point of view, I wish it weren't so.
Now, where are you on China now? The market there has also done extremely well. It's had a very strong run, but this seems to be at odds with an economy that is slowing down.
Yes, the economy is slowing down for sure, Julian. And in fact, we suspect that that 7% figure for first quarter growth is really closer to 6%. The long run growth rate has slowed down from around 11.5% in 2007 to 6.5% now. This decline has been inevitable, and to a large extent it is desirable. But there are two main routes through which the slowdown could develop into something worse. The uneasy stability between the savings to investment relationship could change, and alternatively there could be a rise in household savings in response to concerns about falling housing wealth. Of course, that last one is not likely at this point. But the authorities are planning measures to ease monetary policy in three different ways. And so they appear to be reacting to the short-term concern. And longer term, we suspect that there is less likelihood for China to face a substantial slowdown more than what would be expected or good for an economy that is becoming much larger relative to the rest of the world. So we're still positive. We are buyers of the ETFs representing different parts of the Chinese market until proven that there really is going to be a more significant downturn that cannot be controlled.
And you mentioned... Sorry, please go on.
That's it.
You mentioned that your forecast is closer to 6% compared to the official 7%. Why that discrepancy?
We're not the only ones in believing that the growth is likely overstated. Citibank is there. Some of the other institutions are. And we suspect it's in the numbers that are being reported and how they are reported and the impact of the numbers and what the government is trying to achieve with them. There is a slowdown. It is being represented in the numbers. We suspect that the slowdown is more. But the market is getting used to the lower numbers, Julian. So I do not feel that we're at that danger level where there'll be a sudden awakening and the numbers will be a surprise. We are seeing the slowdown. It is in a controlled manner. Yes, the numbers are controlled, but we suspect that they are fairly close to the actual slowdown. And the slowdown still, you look at 6%. We in the United States don't really have much to complain about when we hear that number.
Thank you. That was Dodge Dolan, Chief Investment Officer of Lander and Fuse Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.